Have you ever wondered how a private company transforms into a publicly traded entity? How does a business suddenly appear on the stock market, available for anyone to invest in? This magical metamorphosis is brought about by a process known as an initial public offering, or IPO. To understand this process, imagine a company as a growing tree. It starts as a tiny seed, fueled by the nutrients of initial investments, often provided by the founders themselves or angel investors who believe in the potential of this sapling. As the tree grows, it may require more nourishment to flourish. This is where venture capitalists or private equity firms come in, providing larger investments to push the company's growth further. However, there comes a time when the tree is ready to bear fruit, and the company needs even more capital to expand its operations or pay off its debts. It is at this juncture that the company may decide to go public. It's important to note that going public is not a decision made lightly. There's a rigorous process involved, a journey that we're about to dissect. Firstly, the company must choose an investment bank to guide them through the IPO process. This bank, often referred to as the underwriter, is responsible for gauging investor interest, setting the initial price of the shares, and buying the shares from the company to sell to the public. Next, the company and its underwriter must prepare a prospectus, a document detailing the company's finances, business model, and risks. This prospectus is then filed with the relevant regulatory body, such as the Securities and Exchange Commission in the United States. This step is crucial as the regulatory body must approve the prospectus before the IPO can proceed. Once the prospectus is approved, the company and its underwriter embark on a roadshow. This isn't a musical tour, but a series of presentations given to potential investors. The goal? To drum up interest and determine the initial price of the shares based on investor demand. Finally, after all the regulatory hurdles are cleared and investor interest has been assessed, the IPO date arrives. On this day, the shares are sold to the public on the stock exchange. The underwriter buys the shares from the company and then sells them to the public, effectively setting the opening share price. From this point onward, the company's shares are publicly traded. The price of the shares will fluctuate based on supply and demand in the market. To summarize, an IPO is a complex process that involves an underwriter, a detailed prospectus, regulatory approval, a roadshow to gauge investor interest, and finally, the selling of shares to the public on the stock exchange. This process allows a private company to become a publicly traded entity, providing it with the capital it needs to grow, and offering investors the opportunity to participate in its journey. So the next time you see a company listed on the stock market, remember the journey it has taken to get there. The process of an IPO is not just a financial transaction. It's a pivotal moment in a company's life, marking its transition from a private entity to a public one.